Hi, this is Sean Overton with OneStepRemove.com. In this video we're going to discuss what characteristics you would expect to find in a system that might adapt well into a high-frequency approach. The one type of system that will definitely not work with a high-frequency approach is a trending system. So if you expect the market to drift higher or to drift lower, you don't want to consider this approach because it involves using limit orders. And if you use limit orders, there's always the risk that you might miss a trade. Trend trading systems are usually 25 to 40% accurate, and their trending multiples are usually 2 to 3 times the average loss. If you miss a trade, it's absolutely devastating, and you don't want to consider that because that's the risk of using limit orders. Now, if you do use limit orders, that usually means that you have a range trading system, and if you have a range system that works, an ultra-high frequency approach may adapt well to this, and the reason is that with ultra-high frequency, you actually change the way the price behaves by looking at smaller and smaller time frames. When you compare the price distribution on a 30-second chart compared to a 1-hour chart, even though they're generally the same and they are the same security, you find that the distribution and the statistical profile will change a bit. The 30-second will be more like a bell curve, whereas the hour chart or the daily chart is going to be wildly chaotic. So the nature of the data really supports a range trading approach to begin with. The second is that if you are running a range trading system, you can adapt it to market making by using the limit orders with the goal of making a market. And really the reason you want to do this is because you can earn the spread. The spread amount that you can earn will vary by the broker. Some of them will give you opportunities to earn up to a pip, some of them will be half a pip. And by some, I'm actually making that sound like there's a lot more options than there are. There's really only two. You can trade at Interactive Brokers, which almost always has a 0.5 pip spread on the euro-dollar. I've even seen them offer choice spreads, which means a zero spread. And that's because there's so much order flow that there's every institution in the world competing for a huge amount of volume, and they're really fighting over it, and it gives great spreads. Interactive Brokers charges 0.2 pips per trade, but if you're earning 0.5 pips on every order, then on average you should be winding up 0.3 pips in your favor on every execution. MB Trading's a little different. They don't have anywhere near as much order flow, so their spreads are wider. That's good because you earn more. The disadvantage is that you're getting filled a lot less often. I ran some tests on some systems of mine, and I found that I was only getting filled 75% of the time as inside bid or offer on the euro-dollar. So it does come with pros and cons. The big advantage at MB Trading is you get paid for the limit orders. And Interactive Brokers, you are paying for it, but you're a lot more likely to get filled. So you got to weigh that balance for your system and how important the execution is. The reason that you want to consider a high frequency approach is really just the number of opportunities. If you're earning credits every single time you trade, i.e. you're earning the spread, and that spread outweighs the amount of commissions that you're paying, then really the only thing that limits your profit is the number of opportunities that come your way multiplied by the amount you make per opportunity. So the 5-minute chart might make you a lot more money per trade, but you're not earning the commission, you're not earning that spread difference very often, and the number of opportunities that come up are going to be dramatically less. If you drop down to something like a 1-minute chart, you're going to get, you should at least get about 5 times as many trades, which gives you 5 times as many opportunities to earn the spread, which gives you 5 times as many opportunities to earn or lose in the market. But if you really do have an advantage, you'll have to just do the math and figure out, if I'm earning this spread and I'm earning this many trades and the payout is this much on this chart, you really just go through the different charts and you optimize and you figure out which one is likely to give me the best overall advantage and payout over a given period of time. And the other reason that you want to consider high frequency is that usually with any kind of statistics, even if it's a coin flip, and even if it's biased, it takes a while for your advantage to play out. So you might need something like 300 or 400 trades before you really see a trading advantage. If you run it on a high frequency approach, you see the trading advantage come out really quickly. It might come out in as little as several weeks. If you're running this on an hour chart for any trading system, it can take months or even years for that advantage to really play out. And it is also far harder to test because the data isn't as readily available. You can only go back so far before the market has really changed structure in the way it behaves. So it makes it easier to test, you get more opportunities, and theoretically it should be more profitable. It's also gives you the added advantage of earning the spread, so you have an extra ball in your court when you're actually launching a trading system live. If you have any questions about how to implement a market making approach, you can find me at www.onestepremove.com. My name is Sean Overton. Thank you for listening.